Hi dreamers, so today I wanted to go through some new derivative income ETFs, specifically from Goldman Sachs. And in this video, I want to compare it to the popular JP Morgan products of JEPI and JEPQ, and also how they compare to my beloved DIVO. So let's dive in. I wanted to start with this article way back in July of 2023. On dividend.com. And here they basically talk about how popular both JEPI and JEPQ have become in terms of JP Morgan's covered call products. And as you know, I have about $200,000 into JEPQ. I know, it's a lot. So one thing I'm doing is trying to figure out other alternatives to put my money when I'm thinking about income generating stocks and products. So hence my research into Goldman Sachs products. And so back in 2023, you can see here that it was a brand new SEC filing, and that essentially they had launched these two products, GPIX and GPIQ, to compete directly with JEPI and JEPQ. But that these products would sell call options on a percentage of the equity investment's market value. And that one big difference from JP Morgan's ETFs comes down to the options overlay strategy, that JP Morgan's ETFs use equity-linked notes, which allow them to synthetically mimic the usage of out-of-the-money covered call options, but that they don't actually write the options, but rather leverage those ELNs. And that in contrast, the Goldman's ETFs will use flex options, which in effect allows Goldman to take a more aggressive or conservative position as they see fit and as the market changes. In my view, the interesting part about this is that if Goldman decided, they could become 100% defensive, and that if things got really bad in the market, there was a downturn, that these funds could sell all their positions and buy US short-term treasury bills and ride out the storm. So that's interesting. So then fast forward to right after they launched, and I'll reference this Seeking Alpha article, where they talk about a direct comparison between JEPI and JEPQ, and also the QYLD products. So they point out that these funds write covered calls partially against the portfolio, allowing them to participate in some of the market upside. And again, the big difference is they're using flex options instead of ELNs for the premiums. So here they talk about that the override level is generally revised each and every month, and that the fund expects that under normal circumstances they'll sell call options in an amount that is between 25% and 75% of the value of the equity investments in the fund's portfolio. And so taking a step back and thinking about it, the amount of calls the fund sells against the positions can range from 25% to 50%, and perhaps an average being 50%. And they go on to point out that this reminds them of another similar approach used by QQQX, which is a fund I've held for a very long time, where in the case of QQQX, they are watching the VIX in order to determine how much premium it wants to try to harvest. They go on to point out that the funds can write a lot fewer contracts as opposed to the JP Morgan funds. And thus, if a fund is writing calls against only 25% of its holdings, if the manager decides, it will generate only a fourth of the covered call premium yield, but be able to participate in 75% of the upside. And it goes on to point out an important difference using the example of the QYLD versus QYLG funds, where QYLD writes monthly covered calls against the QQQ using 100% of its positions versus QYLG, which only writes calls against 50% of its positions. And down here in the graph, you can see that in terms of total return, QYLG outperformed QYLD because essentially there's no cap on the upside, given that the call caps are only on 50% of its positions. So this is becoming an interesting difference in the covered call ETFs and their strategies, where the ones that have near 100% covered calls are really underperforming ultimately, especially in a bullish market. The last thing I wanted to point out here is that they point out that the flex options used by Goldman are European-style options that don't convert into shares and settle at cash value, so they can be easily rolled up or down forever without worrying about losing your shares. And that flex options are traded between institutions, and their trades may not show up in typical options chains. And that one advantage of flex options is that you can set a price instead of relying on bid-ask spreads, like in traditional option chains. So the net of that is there's just different risks and opportunities with the way Goldman is executing their strategy versus JP Morgan. And so it provides a little bit of diversification of risk by investing across the two. So let's take a look at the description of these products and then fast forward to how they've performed year to date. According to Goldman, the two products are JEPX GPIX, which seeks to maintain style, capitalization, and industry characteristics similar to the benchmark S&P 500, while providing monthly income at a relatively stable rate, which is similar to the promise of SPYI, which I covered in a dedicated video recently, and that their other product, GPIQ, seeks to maintain style, capitalization, and industry characteristics similar to the NASDAQ, also while providing monthly income distributions at a stable rate. And it's worth pointing out that these two funds allow shareholders access to the expertise of the Wealth Investment Solutions team at Goldman Sachs, which in my view is an asset to be aware of. Because guys, there's a lot of new covered call ETFs, and at the end of the day, you want to have some confidence that the management team behind these funds, that essentially you are outsourcing your options strategy to, have all the experience and tools necessary to manage with skill as they're making strategic bets every day with these covered call strategies. And so let's take a look at GPIX. Their goals are to deliver consistent monthly income with lower volatility potential, allowing for participation with rising markets and potential outperformance in negative to flat markets. They've got a pretty low expense ratio of 0.35%. And of course, their holdings are going to be in the weighting of the S&P 500. But you can also click right here and get a download of their specific holdings for that month. And when I do that, you can see all of their holdings. And when you actually scroll down, you get to the specifics around their covered calls, which you can see were on SPY. You can specifically see the flex option. You can see the strike prices and how they've laddered them. And you can see the expiration dates. So that's something I really like, is just the transparency of knowing exactly what their strategy is and monitoring how you feel about that. And you can do the same with GPIQ, where you can see a similar gross expense ratio of 0.35%, the holdings in the weighting of the NASDAQ, and then also the detail of their holdings all the way down to the specific flex options, whereas in this case is on QQQ, what the strike prices are, and the specific expiration dates. So let's cover one more thing before we ultimately go to the comparison, and that's my beloved DIVO. This is such a different fund. It's very custom and very defensive. You can see only 36 holdings. It's also a monthly yield of 4.81. The top 10 holdings are here. Microsoft, UNH, Apple, Home Depot, Caterpillar, Procter & Gamble, Visa, Goldman Sachs, JP Morgan, and Merck. And they just talk about having sector balance, screened and adjusted stock selection, but also this is the big difference, that the covered call options are written on the individual stocks on a tactical basis and not an index approach. So the expense ratio on DIVO is much higher than the others, but part of that is because of the active management on this particular ETF and the more defensive position of DIVO. So with all that said, let's finish this out with a direct comparison of total return of some of the key ETFs we just covered that are managed pretty differently in their call options and how that has performed in different conditions. So as you guys know, I'm a Seeking Alpha affiliate, so I've created this graph from scratch in Seeking Alpha. I have JEPI GPIX JEPQ GPIQ, DIVO, SPYI, and just for comparison's sake, QYLD, which you know I'm not a fan of in general. And so just doing a 6-month comparison, where they all start the race at 0%, you can see as we go along into the first market dip. On February 21st, 2024, DIVO is in the lead at 6.32% total return, followed by GPIX at 6.12%. Then as the market starts to do a little bit better and hits a peak on April 11th, 2024, JEPQ is in the lead at 12.16% return, followed by GPIQ at 10.72%, and then GPIX at 10%. Then we go forward into the big dip on April 19th, and lo and behold, we have DIVO now in the lead at 8.21%. And so we can start to see that defensively, DIVO has the best characteristics. We then go forward again into the dip of May 1st, and lo and behold, DIVO again is in the lead at 7.38%, followed by JEPQ and GPIX. And then as we go forward into the rapidly rising and bullish market, we can see JEPQ surging ahead to 16% total return, followed by GPIQ and GPIX. But if you notice all the way across, JEPI is dead last, which is one of the reasons why after a short test period, I exited completely out of JEPI. So what am I going to do with this information? Well, I think that GPIX and GPIQ are interesting alternatives as I think about investments for income past JEPQ. And if you watched my recent portfolio strategy video, you know that a certain percentage of my portfolio is going towards income generating positions. And so right now I'm in the market to try to identify different opportunities to help me balance different market environments. So I'll probably be adding GPIQ and GPIX to my mix. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.